Hi, this is Jeff Haig, and this video is going to introduce us to Chapter 9 of the textbook, which is Business Income, Deductions, and Accounting Methods. This chapter, you'll be covering a lot of concepts about what is a deduction, and also how much of a deduction that is both personal and business, what amount of it you can deduct for business purposes. So I like to start with looking at the first learning objective. And before you watch this video, print out the chapter or have the book in front of you. You could look at Schedule C as we talk about, but we won't be referring to Schedule C really during the chapter. All right? Business gross income on page 9-2. Okay, basically, it's what we've said before for an individual. For a business, it's whatever income the business gets, the business or earns, it has to report. Okay, and we'll be talking about a couple different ways to report revenue at the last learning objective of the chapter, learning objective 5. Looking at learning objective 1, they talk about my business deductions, and basically it is any expense that an individual has or a business has, if an individual is paying it for business purposes, that is ordinary and necessary, and that is related to a trade or to a business. A business could be, being a landscaper, which they use in this chapter, or being a dentist, or being a bookkeeper. That would be like a service providing to someone. Or selling merchandise. We really don't get into selling inventory in this chapter, but that's another business. And also a trade or business could include a rental property, because that is a business. It's kind of like a trade. So whatever is ordinary and necessary, they talk about this on page 9-3, whatever is ordinary and necessary, that can be a deduction for the business. And they give examples in the middle of 9-3 and Exhibit 9-1, advertising, wages, travel, and so forth. They give examples. 9-1 is a good example. And remember that if some of it's a personal use of that expense, only the business part can be deducted. Page 9-4 mentions reasonable amount. It would be like paying for something that's going to last several years. I can only really deduct what happens or what I use up in that year. They talk about limitations on business deductions on 9-5. If I do something that's against the law, I really can't deduct that. Or if I get a ticket or I pay someone a bribe, I really cannot deduct that. But then there's the argument that the bribe is done by everyone or it's customary, then the bribe can be deducted. So it's a very iffy line between what can be deducted if it's a bribe and if it can't be deducted if it's a bribe. Political contributions, not deductible. 9-6 is where they talk about capital expenditures. Basically, that paragraph says, if I buy an asset or buy something that's going to last more than a year, I can't really deduct the expense for that item. Think about so you really can't expense the cost of the truck. We'll talk about expensing the truck over several years in a future chapter. That's what we call depreciation, when I'm going to deduct the capital item that I bought over several years. I call that depreciation. 9-6 also, if I have expenses related to tax-exempt income, the law does not let me take those expenses because I'm not paying taxes on that income, like municipal bond interest. The tax law is not going to let me take expenses related to that interest. 9-7, they talk about personal exemptions or expenditures. Personal expenditures cannot be taken by an individual unless stated specifically in the law. And we saw in a couple prior chapters that most of my individual expenditures can only be taken on Schedule A as an itemized deduction, and can only be taken if the law specifically tells us it can't be taken. So we have to make sure that the business expenses are treated and separately organized, separately recorded from the personal expenditures of an individual. So they talk about that, give an example on 9-7. They talk about that for a couple paragraphs. Chapter 9-8, I'm sorry, page 9-8 at the top, they start talking about mixed motive expenditures, meaning some of them are personal and some of them are business, but I pay for this total expense. I have to break it out between what it is. And the big thing here is what they call meals and entertainment. Basically, meals, if I pay for meals for the business, or the individual has a meals expense going out to dinner, or takes a client or a customer out to dinner or to a football game or to a you know a show or something, only 50% of that can be deducted as an expense. Only 50% of it. The other 50% is not allowed as a deduction. Okay? So they give examples of that on page 9-8. On 9-9, they talk about travel and transportation expenses. Transportation expenses are usually those expenses like getting from one client to another client, perhaps, or if you're going from one yard, if you're a landscaper, to another yard, that could be considered your transportation expense. Travel expense is usually when a taxpayer or an individual is away from home. They can take some of those travel expenses as a deduction if it's business related. And notice it says away from home. Okay? If you look on page 9-9, that bottom paragraph, in contrast to transportation expenses, travel expenses are only deductible if the taxpayer is away from home overnight while traveling. Okay, this becomes another big issue if certain expenditures are deductible, and only deductible if a taxpayer is away from their home. Like we mentioned in class when we had our meeting a few weeks ago, those two nurses traveling around, they couldn't deduct any of their travel expenses because they were technically never away from home, because they didn't have a home, because they didn't have a place where they lived for a few weeks or a month of the year. So none of their expenses were deductible. None of the travel expenses. On page 9-10, this example, I'm just going to read from the book here or look at the book. Example 9-8 gives an example of a trip someone takes and how if some of it's personal and some of it's business, what amount can be deductible as a business expense. So they go through a couple examples there. The first example is when the whole trip is business related. And then the second example in 9-8 is when they're putting some of it towards personal and what amount can be deducted as a business expense. 9-11, there's a paragraph there about property use. Lots of times people who have a business are using their own car to do work or drive around for business reasons. So they have to keep track of the difference between what's personal and what's business and keep records of that. As the bottom of page 9-11 says, record keeping. It is important to have the record, a travel log, electronic records, or writing down in a travel log about what driving was done to see a client or see another business to do business at, but keeping records of that to help substantiate your deductions that you're taking. And many taxpayers don't do record keeping, or they're very bad at it, and then they just scramble if the return is looked at, or when they have to go to their accountant to prepare the tax return, that they're getting all this information together, trying to make sense of it all. The best way to do it is keep the records going and be a good record keeper as the year goes on. Now, learning objective 9-3 start talking about specific business deductions. They talk about this domestic production activities deduction, okay, the DPAD, another thing in the tax law to make things complicated. Read it, okay, just know that's there, and sometimes a business can take this deduction, okay. 9-13 at the bottom, losses on dispositions of business property, okay. We haven't talked about really about when someone sells property or it gets destroyed, but if it's business related, it's usually all deductible. Now if you look on 9-14 and see where it says business casualty losses, we learned in the previous chapters that when an individual has a loss or a theft, they can take the deduction, but it's an itemized deduction, and then it's subject to limitations such as 10% of adjusted gross income, and then $100 less, they can take that amount as an itemized deduction. For a business casualty loss, usually most of it's deductible as whatever the loss was as an item for adjusted gross income, okay? For adjusted gross income. When an individual has a loss that's a personal item, we saw that was a deduction from adjusted gross income. So if it's a business related, most of it's deductible right away as a casualty loss for a business. A business property like a truck gets destroyed in an accident, or a computer gets stolen, that'll be a casualty for the business. They give an example that in example 9-12. Okay. Now 9-15 is where we start looking at our learning objective number 4, and they start talking about accounting periods. And this is only basically a page long, and basically read this, of course, but basically it's telling us that individuals, a person, okay, an individual has to use a 12-month period, and most individuals, 99% of individuals, use this January 1st to December 31st as their year. And most of us, I'm sure in the class, or all of us in the class, use the year January 1st to December 31st as our year. And that's 12 months. So they mentioned that. And then at page 916, they talk about 3 different types of businesses here. Sole proprietorships, because usually an individual, a person, is operating a business as a sole proprietorship, which gets reported on their Schedule C. That sole proprietorship, that business on Schedule C, will follow the same year as the individual. So January 1st to December 31st, and 12 months. A flow-through entity, the second bullet point there on 9-16, partnerships and an S corporation, those type of things we've mentioned before, or just saw a paragraph or 2 of those before. Those flow-through entities, a partnership or an S corporation doesn't pay any taxes. The partners of the partnership pay taxes, report the income, they pay taxes, and then the shareholders of the S corporation, they report the income and they pay the taxes. So the partnership and the S corporation doesn't pay any income taxes. And most of those are treated as 12 months as December 31st year ends. A C corporation can take a calendar year, January 1st through December 31st, a fiscal year, meaning a year that begins July 1st and ends June 30th, or it can take a 52, 53 week year. Okay, Don't get hung up on this 52, 53 week year. Most of that are used by retailers such as Target or Walmart. They use this 52, 53 week year, meaning some years will have 52 weeks, some years will have 53 weeks, and then some years will have 51 weeks. It just depends on when the last day of the year is. And usually the last day of the year will end on a Sunday, but the Sunday will change every year. So they talk about that. So those learning objectives are pretty straightforward and simple. Just new concepts: ordinary, necessary, business record keeping, reasonable amount, a travel expense, meals and entertainment, okay? Stuff like that. Accounting methods, we'll spend the last few minutes on this, okay? Accounting methods. And this, I just want you to read up to where it says inventories. Stop at inventories on page 9-21. I mean, of course, you can read the whole thing if you want, but I would just stop there. Because in these few pages, they talk about two accounting methods which are new to us: cash method and the accrual method. The cash method is what most individuals use. 99.9% of US individuals use the cash method, meaning that when we get the cash, it is income for us to report on our tax return. You know, most of us get paid in cash, and we get our W-2 or our 1099, you know, in January or February of the year after that year ends. We report that cash that we got. Of course, when we report that cash that we got, we also report the taxes that we paid, because we paid them all from cash. So we're using the cash method. The accrual method is when a company, usually it's companies, large companies, small companies too, but lots of large companies, you know, Starbucks, McDonald's, Walmart, they use the accrual method, meaning when they did something, they recognize or report the income right then. Not when they get paid, but when they do the work or provide the service, they report the income there. So I want you to read these few chapters to understand those two accounting methods. It goes into a little accounting concepts, but don't worry, it gives a good example of what they're talking about and lays it out there in a good way. And if you have any questions on it, you can post those questions or let me know if it's a little concern for you about what they're talking about between this cash method and this accrual method. Basically, once again, the cash method is used by most people, and that is when we show income or report income when we get the cash, when we have control of it. The accrual method is when the company reports or shows income when they earned it, when they did the work, no matter if they got paid or not. When they did the work, they'll report the income. And for companies using the accrual method, it's the same with the expenses. When they know about the expense, when they know they have this expense, they'll report that expense. They may have not paid for the expense yet, but when they know about the expense, they'll show it as an expense on their tax return. Now the goal is to pay taxes later, take all my deductions as soon as I can, and pay my taxes years in the future if I can do that. Okay, we've talked about this already. Taking all my deductions as I can, deferring my income into the future. We're not avoiding we're avoiding taxes, but we're planning right, because I'd rather keep the money now and not give it to the government. I'd rather give the government the money in the future. So if I can do that, being legal, that's what I want to do. I want the money now. I don't want to pay the government now. I want to pay them later. Accounting methods, okay, at the bottom of 916, they talk about my two methods on page 917, financial and tax accounting methods. Financial accounting is basically using accrual method, financial statements. Tax accounting, the tax law may be a little bit different. So there's two set of rules. Okay, they talk about these accounting principles. These accounting principles are used by companies, large companies, but they also have to follow the tax rules, which could be a different set of rules. Okay, not that the government's trying to make people pay taxes sooner than later, just the rules they have to promote certain activities, as we've seen before. Activities for individuals, go to school, um, adopt a child, try and think of what else. Those things, buy a house, okay? Those things, make charity deductions. Those things are to promote social activities. With the tax law may say buy new equipment, you can expense most of it right away. Or build something or put in something into your business, you can take a tax credit for that. Such as if you put in certain ramps for this individuals who are disabled, you can take a tax credit for that. Okay. On 917, as I said, they talk about the accrual method and then the tax method, or what the tax law is. The cash method is talked about down below on 917. Okay, I'm going to read from the chapter here. Cash method. A taxpayer or business using the cash method of accounting recognizes revenue when property, cash, or services are actually or constructually received. Remember the constructed receipt document? Once an individual or a business gets the cash, they report the income then. Doesn't matter when they did the work or will do the work, they report the income then. This is generally true no matter when the business sells the goods or performs the services that generates the revenue. Likewise, a business adopting the cash method generally recognizes deductions when the expense is paid. Thus, the timing of the liability, the bill, giving rise to the expense is not important. Okay? Cash method, when I get the cash, it's income. When I pay the item, it's an expense. Okay? Now, they talk about the 12-month rule, and a good example of this is example 914. They have 3 scenarios here in example 914. I won't go into each example in detail, but example 914 looks at 3 things. One thing is that they pay $1,200 for insurance and it doesn't exceed 12 months, they can write off the whole amount as a deduction, $1,200. In the other example, if the policy was still 12 months, but it goes from February, okay, runs from February 1st of next year through January 31st of the following year, none of it can be deducted because it's over, okay, it goes on to the next couple years. Even though it's a 12-month insurance policy, it's going into the next couple years, so they can't deduct it until it's actually used up. It's like my car insurance. If I pay for some of it in advance, I cannot really deduct some of it right now. The next example is that it's an 18th month policy, okay, for $1,200, and he buys it July 1st. You can only take some of the expense in this year, $400 worth of it. So go through those 3 scenarios in that example. It's just telling you how things can be deducted and in what year they can be deducted. The accrual method is at the bottom of 918, and we talked about that a little bit, okay? When income is recognized, usually when it's earned, and when expenses are recognized when they're known about. And they give more detail on 919 here about this all events test for the income. And example 9-15 is a good example showing what cash method accounting is and what accrual method accounting is with this example on 9-15. Okay? Talks about the individual and when he gets the money and when he's going to do the services. So depending what method he's using, this landscaper, cash method, he usually would recognize all the cash when he gets paid. The accrual method, he won't recognize any revenue. Even though he got the cash, he won't recognize the revenue until he starts doing the work. Okay? And then they talk about being paid in advance, this unearned income on the bottom of page 919. Unearned income, think of it like when I buy tickets to go to the football season. Okay? Some of those games are going to get played this year, some are going to get played next year. Usually the company can only recognize the revenue when the games are played. Okay? But they get all the cash up front. On page 920, they talk about unearned service revenue, and they also talk about advance payment for goods. Okay? Advance payment for goods, there's two things a taxpayer can choose from: full inclusion method and deferral method. So either way, I can select one of these methods to recognize my income. An example 9-16 is good that it shows you how this works. And a taxpayer can include all the income right away, or they can defer some of it. And of course, you may be thinking, well, why do I want to include any income right away? But in some cases, I may want to include my income if I have a lot of deductions in that year. So I'll include the income sooner than later. Or maybe I'll defer some of it to just pay tax on it later. If you look at this example, 9-16 here, so in late November 2015, Rick got $7,200 from a client to do monthly work from December 1st, 2015 to November 30th, 2017. $300 a month for 24 months. Under the accrual method, Rick would recognize $300 income for the first month of work he did, December 2015. Even though he got, $7,200 in cash, he'll only recognize $300 in December of the first year, because that's when he did the work. In 2016, he would recognize the remaining $6,900 rather than only the $3,600, okay, related to 2016, because he is not allowed to defer the prepayments for services for more than a year. Okay, he can't defer it past 2016. Under the cash method, just reading from the top of page 921, under the cash method, Rick must recognize the entire prepayment, $7,200, as income upon getting it in 2015. Okay? So if he uses the accrual method, he can recognize some of it in 2015 and all of it in 2016, which I think is a good idea because I'd rather pay my taxes in the future year. But if I'm on the cash method, I'll have to recognize it all right in 2015. The other example is that suppose that he'll get 7,200 prepayments for delivering grass at a cost of $1,800. 5 pallets will be delivered in 2016 and the remainder delivered in 2017. When would Rick recognize the income? Under the accrual method. The cash method, he would recognize it all right away. Under the accrual method, or if he chosen the full inclusion method, he would recognize the entire prepayment of $7,200 as income minus how much the grass cost him, $1,800, in 2015. If he selected the deferral method, then he would recognize the income as the sod is delivered, as it's happening. So $2,400, 2016, and the cost $600, and then in 2017 he would recognize what was delivered, $4,800 minus the cost of goods sold, $1,200. So just understand these two methods, okay? You won't have to memorize them for the quiz, but the homework does have a question about these few pages in Learning Objective 5. So you want to understand these examples because the homework looks at the examples to give you an idea of how the methods are used. Okay? And like I said, don't start reading from the inventory section because it goes into a lot of detail of if I have inventory, when I have to recognize my things I do. Okay. Page 932 has a Schedule C there, which we'll be looking at when we do the final exam. We'll have to fill one of those out because I think it's important to know because many people in our community have a Schedule C, and it's good to know to fill it out completely because that's the problem some of you had on the midterm. You did not fill out that tax return to all the information you had. Okay, that's important to do. Discussion questions. Discussion question number 1 is good. And let's see what else. The number 6 is good. Number 5 is good. It helps us understand what is important between deductions or what can be deducted. Question number 13 is also good. Question number 11. And the number 21 is good to understand the different years that a sole proprietorship, a flow-through entity like a partnership or an S corporation and a C corporation has. And also 24 is good, and this helps us understand that what's capitalized and what's expensed. And also question number 27 is good. Just some things to think about that help us understand that there's different rules for accounting and there's different rules for tax returns. Okay? So I hope this video helps you understand this chapter, and I know I went over 30 minutes on this, but I hope it helps you understand this chapter. And post any questions you may have, and I will see you on campus. Thanks.